All right, so just finishing off this higher-level sole trader question. The last few adjustments are over the other side of the page here, which is just off camera, so I'll just read these. So provision should be made for mortgage interest due and investment income due. So we've been making kind of mortgage interest due adjustments already. Investment income due adjustments are going to be very similar. So let's do the mortgage interest one first. So let's figure out what it should be, and then what's in the accounts already, and then that'll give us our mortgage interest due. So we've already figured out what 3 months should be, okay, in this working 7 here, okay. So first 3 months interest 3,600, and then for the rest of the year, so we increase the balance, so it's 200 grand that we owe from the 1st of April, okay. So for the remaining 9 months of the year, it's 200,000 balance multiplied by 9%, the 9% mortgage. That would give you a full year's depreciation. So multiply that by 9 over 12 to just get 9 months depreciation. So if you do 200,000 by 9% is 18 grand, by 9/12 is 13,500. Okay, so if you add those together, then 17,100 is what mortgage interest should be. Okay, so that's what's going in the profit and loss. So we need to put in all of 2019's mortgage interest in the accounts. So that's what's going in the profit and loss. It's an expense. Remember, it gets added off. Subtracted off just before net profit. It's like the last thing you deduct before net profit. What was in the accounts for mortgage interest was 4,500, but we were told that was a mistake, and we've corrected that mistake here. Okay, so really it's 3,600 which is sitting there as mortgage interest paid for the first 3 months. So of this mortgage interest, I have paid 3,600. So this 13,500, it's the last 9 months of the year that I haven't put in the accounts as an expense. So that's your mortgage interest due. So that is interest for 2019 that you owe at the end of the year. So that is a current liability. All right. We'll go working 9 then for your, it says provide for investment income due as well. So you've got 12% in investments, and they cost 150,000. We have already done something with this. So we've already said that a full year's income. So 1 year's investment income is 18,000. So the 150,000 investments by 12%. When did we actually buy these investments? The 1st of June. Just be careful here. That excludes January, February, March, April, May. So that excludes 5 months. So that's 7 months. So from the 1st of June is 7 months of the year. It's very easy in your head to think that's 6 months of the year, but from 1 June would be 7 months. So 18 grand is a full year's depreciation. So let's multiply that by 7/12. And that's 10,500. So that's what the investment income should be in the accounts. Okay, so that's going to be other income. All right. What have you actually received for the year? Well, it told me that 4 months investment income was included in with Peyton, so I must have received that for 4 months, or I've certainly put it in the accounts anyway. So, of the 10,500, if you subtract the 6,000 that you've already put in the accounts, you've already received, you get €4,500 investment income due. So income due at the end of the year is like, that's what debtors is. Okay, so that's going to go in as a current asset. Okay, now you'll show it separately to debtors. You'll show it as investment income due 4,500, but it's money you're owed at the end of the year. So that's a current asset. All right. So that's my mortgage interest and my investment income provided for. The next adjustment then, so adjustment G. A new warehouse was purchased during the year for €60,000 plus VAT at 10%. The amount paid to the vendor was entered in the building's account. No entry has been made in the VAT account. So we paid 60,000 plus 10% VAT. So working 10. So we paid 60,000 for a building plus 10% is 66,000. Okay, that's what we actually paid for that building. Okay, the VAT that you paid, you're going to reclaim. Okay, so when you pay VAT on something, you then claim that back from the government. Okay, and then when you sell something, you add VAT onto it and you pay that VAT over to the government. So the 6,000 VAT is not actually part of the cost of the asset. Okay, so it's the 60,000 which should go in our accounts. Okay, the 6,000 then is going to go into my VAT account. All right, so you're going to put the VAT exclusive amount in to buildings. Okay, because even though you've paid over 66,000 for the building, you're going to reclaim 6,000 from the government. So it's actually only 60 grand that you've paid for that building. Okay, that's the cost of the building. So it's the 60,000 which should go into the building's account. It tells me that the amount paid to the vendor, the amount paid to the person you bought it from, was entered into the building's account. Okay, so buildings. In the accounts, cost 656, so buildings cost 656,000, and that includes 6,000 VAT, so I'm going to take that away. So 650,000 is your actual buildings cost. Okay, so that's what should be there in the account, 650 grand. The other entry then, so VAT in these accounts is a credit. Okay, so that's VAT that we owe. All right, it's a current liability. Now, the €6,000 VAT, I've subtracted that away from buildings cost. Okay, so buildings cost is kind of, it's there, but it's sitting on the debit side of the it's sitting here on the debit side of the trial balance. So if I subtract 6,000 from this, I'm making an entry on the credit side. Okay, so if I subtract 6,000 from this, it's like putting 6,000 in over here. So the other entry here needs to be a 6,000 on the debit side. Okay, VAT is sitting there at 7,700. You're going to take 6,000 away from that because you're putting 6,000 in on the other side of the account. So you're going to reduce this by 6,000. So the VAT balance is 7,700. And and you're subtracting 6,000 from it. So 1,700 is what goes. So buildings cost 650,000. That's what goes in the balance sheet as a fixed asset. I think we're going to adjust it again later. And then VAT 1,700. That's what goes in the balance sheet as a current liability. All right. So we owed €7,700 in VAT. We're going to be able to reclaim from the government 6,000. So we actually only owe them 1,700. I'd say from the government, from the revenue commissioners. Okay, so from the tax man. Grant, on to adjustment H then. So I'm going to make other adjustments to buildings. So provide for depreciation on buildings at a rate of 2% cost per annum. It was decided to revalue the buildings to 850,000 on the 31st of December 2019. So we're going to revalue the buildings at the end of the year, but we'll deal with that in a second. We do need to put in 2019 depreciation first, though. So we're only revaluing them at the end of the year. So let's do the 19 depreciation. So this is working 11. So from working 10, my buildings cost is not the 656 that's here, it's 650,000. So after taking the VAT out. So buildings cost, I'm taking this from working 10, is 650,000. So multiply that by 2% is equal to 13,000 2019 depreciation. Okay, so that's going to go in your profit and loss account as it's building, so it'll be admin. So that's depreciation for this year, and then it's going to go in accumulated depreciation as well. Okay, added on. But what am I told? I'm told that I'm revaluing the buildings to 850 at the end of the year. So according to your accounts, these buildings are worth 490,000 because you've been depreciating them for a few years. But then they got a valuer in, and the valuer tells them the building's actually worth 850,000. So if it's actually worth 850,000, you shouldn't be carrying it in your accounts as 490,000. It should be in your accounts as 850,000. Okay, so you're going to increase the cost and the net book value of your buildings. All right, so what are we going to do then? We're going to clear out all the accumulated depreciation. Okay, because the buildings cost 650 or 656, and then we've depreciated them over all these years, so we've got a load of accumulated depreciation sitting in our accounts, so we're going to clear that out. Okay, so let's figure out how much depreciation is there. All right, so we've got 13,000 for 2019, and then what other accumulated depreciation is there? Well, they're in there as a cost of 656 and a net book value of 490. So there must be accumulated depreciation of, so accumulated depreciation on the building is 656,000. Take away the 490,000 is 166,000. So that's 179,000 accumulated depreciation on buildings. So that's what I would be putting into the accounts as my accumulated depreciation on the balance sheet. But they tell me that I'm revaluing my building. Okay, so this is going to create what's called a revaluation reserve, okay? Because I'm going to increase the cost of my buildings. I'm going to get rid of any accumulated depreciation. So that would cause that would throw my accounts off, okay, because you'd be increasing a debit balance, okay, so you need to create a credit balance to go with that, and we create something called a revaluation reserve, okay, so it's almost like a profit on your buildings, okay, but it's going to go down in your finance buy. You haven't actually realized the profit yet. You haven't sold the building, okay. It's like a notional profit that's kind of sitting there, owed to you if you ever sold the building or wound up the business, okay. So how do we calculate this revaluation reserve? Well, our starting point is what we actually value the building at. So at the end of the year, we revalue it at 850,000. So the revaluation reserve starts with the new valuation, and that's 850,000. And then you're going to take away the old cost, or like the opening cost, whatever you want to call it. So take away the cost of the building, which we adjusted to 650,000. So if you take those away from each other, you get 200,000 euro. Okay, so you've got a revaluation reserve of 200,000 euro. But remember, we've also got this accumulated depreciation sitting there. So if we say the building's worth 850 grand now, we're not going to immediately take away the accumulated depreciation from it, because then we'll be bringing its valuation down. This is what we're saying it's valued at. This is what should be in our accounts. Okay, so we're going to clear the accumulated depreciation out as well. So that's going to be added on to your revaluation reserve. So accumulated depreciation on the building is 179,000. Add those together and you get 379,000. And that's your revaluation reserve. And that goes in the financed by section of the balance sheet, down the very bottom. Okay, so look, it's a typical enough adjustment you're going to see over and over again. It's a new idea, but if you spend a bit of time getting your head around it, because you'll be doing it quite a bit. All right. Final working then. So provision on bad debts should be adjusted to 4% of debtors. This is the standard one we've seen quite a few times. All right, so 4% of debtors. So what are debtors worth in the accounts? It's 45,400. So debtors 45,400. Yeah, by 4%. So 45,400 by 4% is 1,816 euro. So that's my new provision. So I'm going to take that away from debtors. So 45,400, take away the 1,816 is going to give me 43,584. Okay. I probably would. I'd probably show that in the balance sheet rather than just put in the 43,584. So put in the debtors less provision is 43,584. What other entry do we need to make then? So 1,816 is my new provision. Was there a provision sitting there in the accounts? There was, yes, 2,400 euro. So take away 2,400 euro, and that is 584. And then don't worry too much about the kind of sign on this. What we're interested in is it increasing or is it decreasing? So it was 2,400. It's now 1,816. So that is a decrease in your bad debt provision. Decrease in the bad debt provision is a good thing. So that's going to go in as other income. Okay. And that's all our adjustments done. Okay, so there's quite a few of them there. It took me a good bit of time to go through them all because I'm talking through them all. You obviously need to be kind of getting through these a lot quicker than I did when this comes up in an exam question. But as I say, as you go through questions and as you look at exam papers, you'll see the same stuff coming up again and again. So you'll be able to kind of move through them a lot quicker. Just looking through the trading profit and loss then, So most of that stuff is stuff we've seen before, and it's in the places we've seen it before. Just patents written off goes in as an admin expense. That's new. Profit on the sale of vans is other income. Investment income here, they're showing separately to other income. So before you add on the investment income and after you take away the mortgage interest, just that, I'm not sure if operating profit has come in before as a term. So just before you get to net profit, before you take away mortgage interest, before you add on investment income, operating profit is what you would call that, because that's like from the operations of the business, and then like the investment income and the mortgage interest are a little bit separate to the actual day-to-day business. That's everything new in profit and loss. So just quickly flip through the balance sheet as well for anything new here. The intangible fixed assets we've seen before, as I said, it's the net amount you put in. So you 56,500 take away the write-off, and we just put in the net amount. We don't bother with the cost and the accumulated depreciation and net book value equivalents for that. The buildings is just going in as 850. So we revalued it at the end of the year. So we cleared out any accumulated depreciation that was there. Okay, so including this year's depreciation, we did it at the end of the year. So that's all cleared out. So it's just in as 850. The delivery vans, just be careful there, because you took some accumulated depreciation out when we did the disposal. So that'll be all in your workings. Financial fixed assets then will just go in the I think we've seen those before. As I said, I generally wouldn't put a fourth column in here. I'd probably start with tangible fixed assets and then bring the intangible and the financial in and add them on here. Current assets, we've seen all these before. As I said, investment income due would be a current asset. Creditors, we've seen all those before. The fixed mortgages, your long-term liability, your creditors due after 1 year. So just it's the revaluation reserve where that goes. Okay, so your long-term liability, your loan, capital plus net profit less drawings, and then you add the revaluation reserve onto that. Okay, so it's down in the financed by the 379 that we figured out in the second last working. Okay, so that's that example done.